China is both our biggest economic competitor and our biggest military rival. So that's going to require a special kind of formula.
Are you teasing out a Mar-a-Lago Accord that we should be paying attention for in the future?
I'm not sure what you're talking about.
Well, potentially getting all these trading partners together to discuss fair, balanced trade?
Well, we're doing that over the next 90 days.
Is Trump trying to crash the dollar? Some of you have heard of the Plaza Accord. This is the 1985 agreement that reshaped global currency markets, but in 2025, there's talks of something far more explosive.
You are fake news.
That is not fake news, and I'll get to that in this presentation. So what we're talking about is a potential deal where the U.S. forces its allies to accept a weaker dollar and lower interest payments in exchange for American military protection. I wish I had a Sopranos sound effect on this soundboard. I need to get one. This is called the Mar-a-Lago Accord. So I'm going to walk you through how this idea works, why it matters, and why it could fundamentally change global trade, monetary policy, and U.S. national security forever.
I'm going to come.
Okay, so the term Mar-a-Lago Accord was first coined by Zoltan Pozsar. He's one of the sharpest minds in money markets. He was inspired by the 1985 Plaza Accord. This is where the U.S., France, Germany, Japan, and the U.K. agreed to jointly weaken the dollar to fix global imbalances. The idea here, this is a modern version of that, which I'm about to show you the picture right here, but it's not hosted at the Plaza Hotel. It's hosted at Trump's Mar-a-Lago Resort. You can see in this picture, we had Germany, France, United States, Great Britain, and Japan. So this isn't just symbolic. The idea is that under Trump's administration, the United States is going to pressure its trading partners, especially those under America's defense umbrella. They're going to accept a weaker dollar and lower Treasury yields as the price for continued U.S. protection. Again, I wish I had a mafia sound on this soundboard because that's exactly what it sounds like. So if you want our missiles in our markets, great, you can have those, but you're going to take them with a weaker dollar, less interest income, and more American-made goods. So why does Trump want this? So this is rooted in Trump's economic worldview. In his eyes, the strong dollar is the villain, okay? This is why factories moved overseas, and I'll show you some charts here in a little bit. It's why we import everything, and it's why American blue-collar jobs, the heart of the middle class, disappeared, as you can see from this tab right here, this chart right here. So the U.S. dollar is strong because it's the global reserve currency. That means central banks, sovereign wealth funds, and global businesses hold trillions of U.S. dollars in treasuries. This drives up demand for dollars, making them expensive. This is great for Wall Street, but it's terrible for manufacturing. So this is called the Triffin's Dilemma. Triffin's Dilemma is basically a paradox that arises when a country's national currency also serves as the global reserve currency, as the U.S. dollar does today. So to supply the world with enough dollars for trade and reserves, the U.S. must run persistent trade and budget deficits, which over time undermines the confidence in the dollar's long-term value. In other words, the very act of providing global liquidity, which is supporting U.S. dollar dominance, which is why I invest in VTI, total U.S. stock market, it actually creates unsustainable debt and economic imbalances that threaten that dominance. So it's kind of like a catch-22. What's needed to maintain the system ultimately erodes it. So let's take a look at this chart. You can see that Trump sees the stronger dollar as the main reason for the falling share of U.S. industrial jobs. The light blue line is the share of U.S. jobs in manufacturing. The dark blue line is the nominal trade-weighted U.S. dollars. And on the left-hand side, there's the index. And on the right-hand side, you can see it's the percentage of total payrolls. And if you look at the light blue line, you can see how much that's declining. Now, if I show you this chart right here, you can see manufacturing employment. So the light blue line is the share of total employment as a percentage. You can see that right here. And then the dark blue line is manufacturing employees. So you can see a steep decline started basically in the mid to late 90s. And it's starting to gradually go back up, dip down during COVID, and now it's back up again. But we're basically just chilling at levels that were, I don't know, mid-2010s. And then before that, 1945 during World War II. You can see that right here, you guys. So if I continue, you can see the U.S. share of world GDP, which is going to play a role in this video. You can see from basically 1960 all the way to 2022, our share of GDP basically went from 40% all the way to 25%, but it is on the rise, which is good. Okay, so how do we tie all of this in with the protection component, the security tie-in? So here's where this gets very geopolitical. So Trump doesn't just want fair trade, he wants fair burden sharing. So that means if we're defending Europe, Japan, or South Korea, they should pay more for that protection. Again, I wish I had a Tony Soprano sound on the soundboard, but I don't, so I'll play something similar.
I'm going to come.
So countries under America's defense umbrella would face a stark choice: pay more for defense, accept a weaker dollar, which makes U.S. exports more competitive, and accept lower interest rates on their massive U.S. Treasury holdings, which I'm going to show you here in a second. So in other words, no more free rides, okay? Gas, grass, ass. I think it's how it goes. No free rides. And this isn't just a theory. We've already seen the early signs. We have NATO countries ramping up military spending after Trump's threats. We have U.S. tariffs forcing companies to reshuffle global supply chains. And we also have a gradual weakening of the dollar as investors pull out of U.S. assets, which I'll show you later in this presentation. If we take a look at these two charts right here, on the left, we have defense spending. The dark blue line is the United States. The light blue line is the EU. And if we look at the chart on the right here, you can see defense spending and public debt. So on the right-hand side, we have percentage of GDP. On the left-hand side, we have trillions of dollars. And on the bottom right here on the x-axis is basically years. So this starts in 1970, goes to 2025. And you can see the dark blue line is the U.S. defense spending total. And then the red or pink line, however you're seeing this on your monitor, is the U.S. public debt divided by GDP. Okay, so how would the Mar-a-Lago Accord actually work in practice? So the Accord would rely on three tools, and I'll show you right here. So we have tariffs. We would raise them strategically to hurt countries that don't comply and reward those that do. So tariffs, they generate revenue, incentivize reshoring, and act as a pressure point. Then we have the currency strategy. So we use policy levers to allow the dollar to weaken, either through coordination or more radically by reducing the appeal of treasuries to foreign holders. And then third, we have security leverage. This is threatening to reduce protection for countries that don't agree to new terms. This ties defense spending directly to economic concessions. So there's even talk through extremely unconventional and controversial means of taxing foreign-held treasuries, which I'll show you right here. So this is reducing coupon payments or even restructuring U.S. debt owed to other nations. And that's the nuclear option, because once you touch treasuries, you touch the foundation of the global financial system. And again, remember, guys, the Triffin's dilemma, we are the world reserve currency. So we can't just go to, like Japan with negative rates or start threatening U.S. treasuries because so many foreign holders hold them. So if you look at U.S. treasury holdings by investor type, you have domestic private, which is pink or red. You have the light blue, which is the Fed, and then dark blue, which is foreign entities. And those have only gone up since 07 or 06, according to this chart. So again, left-hand side is trillions of dollars. Right-hand side is trillions of dollars. X-axis is the year, basically starting in 06, going all the way to 2025. So here's where it gets messy. Countries like China, they have massive trade surpluses and a deep interest in keeping their currency cheap. They're not going to roll over. So China isn't dependent on U.S. military protection, and it may retaliate hard. And then we have Europe. Weak. So they might actually bend because rising military costs and inflation may actually force them to accept weaker returns on their U.S. assets in exchange for staying under the U.S. security umbrella. And then finally, investors, they may actually start pulling money out of the U.S., weakening the dollar further and driving up volatility. We're talking about a potential reordering of capital flows, supply chains, and geopolitical alliances. So if we look at this, a global reallocation out of the U.S. would lead to a large hit on the dollar, while defaulting on U.S. treasuries would increase the yield risk premia markedly. So U.S. net investment position, pink is just other, bonds is light blue, and then equities is dark blue, stocks. Now, if you look at this little blurb right here, China has by far the largest trade surplus with the U.S. and is heavily dependent on keeping its currency from appreciating. They are not very likely to succumb to pressure from the U.S. These aren't Chinese peasants from 200 years ago, you guys. Everything is made in China. BMW motorcycle engines, Apple products. As long as you can give them the proper plans and guidance, Chinese have the ability to make anything, okay? My dad was in injection molding for a long time, worked with plastics design his whole life, Everything is made over there. He went to Hong Kong, Shanghai, Macau. This was let's see, I'm 37. This was probably 26 years ago, 25 years ago. When he came back, you know what he told me? Learn Mandarin. Okay, so is this actually going to happen? So here's the thing. Trump hasn't officially proposed this, but many of his policies, the tariffs, the NATO pressure, anti-globalization rhetoric, they already align with the Mar-a-Lago Accord playbook. And Stephen Moran, who I'm going to show you a video of here shortly, this is Trump's top economic advisor. He's the one that literally wrote the guidebook. A lot of this information is coming from that PDF. So it outlines how to reshape the global trading system using tariffs, debt restructuring, and security incentives. So while a Plaza-style coordinated agreement is unlikely today, the unilateral version of the Mar-a-Lago Accord is already being implemented piece by piece.
A currency accord, a Mar-a-Lago Accord, is that currently in the works?
The president's been very clear that he's focused on fair and reciprocal tariffs, and you know that's what the team is working on.
Is it a 2026 goal to do a currency pact?
I mean, look, I would look at it this way. I would look at it as the United States has been running some very significant trade and current account deficits for a very long period of time. Those are very costly to us economically. They're very costly to disproportionately costly to some parts of the country that are reliant on manufacturing or reliant on exports. And there's a variety of means of trying to address that problem. Right? The president's been very clear that he wants to start with tariffs. And that's what we're doing, right? We are starting with tariffs. We have been moving in tariffs. We are going to continue moving on tariffs. April 2nd is around the corner, and that's the sole focus right now. Could it be something that is entertained down the road? Sure, it could.
Okay, so what does this mean for investors, for policymakers, and most importantly, for you? Okay, if you haven't already, subscribe, hit the bell, share with 13,000 friends, please. So expect a weaker dollar if these policies are pursued. You can see the screenshot that I took earlier today. This is the United States to dollar ratio. It is at 0.88 euros per dollar, okay? I remember a couple of summers ago, it was almost 1-to-1 parity, okay? Now you can see it dropping pretty drastically. But it's always historically kind of been like this, so don't take this as like sensationalism. But you can see the sharp decline right here at the right-hand side of the chart. Now, also expect higher tariffs and trade conflicts, okay? Is Trump going to capitulate? We've kind of been seeing that over the past week since I made my last video. But again, those could always come back. And then also market volatility. So especially in bonds and currencies, here's the VIX. This is equities. You can see right here that this is basically a 5-year chart. And look at this big spike from when Trump basically took office. And it's coming back down just as fast. So very turbulent in my opinion. And then also we have the new economic order. Security, sovereignty, and economic strategy are becoming intertwined. So we recognize that we're entering this new phase of American economic power. So those things that I just mentioned, I don't know, is this more about trade? Is it more about reshaping the rules? I mean, is America as strong as we think we are? I don't know, right? This isn't us picking on little countries in the Middle East like we've been doing for the past 30 years. This is China. Hold on, I don't know if I have one second.
China.
I'm going to come.
Sorry.
Made in China.
Made in China. So this is about reshaping the global economy. So as always, if this breakdown helped you understand what's really going on behind the scenes, hit the like button, subscribe, and share the video with someone, 13,000 friends, who still thinks this is just about taxes. Okay, I think this is a much bigger picture here. Let me know in the comments below. Do you support Trump's vision of a new economic order? Or is the Mar-a-Lago Accord too risky? Okay, do you think this can even be implemented in our current state? Are we in late stage empire? I don't know, you tell me. Thank you so much for watching and have a prosperous day. Peace. And don't forget, you guys.
It's all going to zero against Bitcoin. If you don't understand that yet, you're going to be impoverished.